All right. So yeah, like Jay said, I'm going to give you an update predominantly on your market area. So I'm going to be talking about the Orlando metro area, and I'll throw in some statewide and some national data there as well. But mostly we'll be focused on your market. So why don't we just get started? I threw a lot of slides in. I know we have up to an hour today, so and I wanted to leave some time for questions. So we'll see how much I can get through, but there's a lot going on. Let's just say that in real estate, and you very well know that, being that you are the people on the ground making it happen in terms of keeping our industry moving. So I'm just going to start off with, the I guess it's not the elephant in the room, unless, that expression, I guess, works if we know there's definitely an elephant, and there is, and it's the interest rate for the 30-year fixed rate mortgage. That has really been dictating a lot of what's going on in our market for the past year. So just for a wider perspective, I've put the Freddie Mac measures weekly through a survey of originators and lenders what the 30-year fixed rate mortgage is on average in the United States, and I've averaged it out over months. Their data goes back to 1972, and you can see clearly in the late 70s, early 80s, during that time of inflation that we had before the current one, you can see how high mortgage rates got. And those of you who are more experienced in the real estate industry, I've noticed your hobby has become telling the younger folks in the industry just how high interest rates got back in the early 80s. And here on this chart, it peaked above 18% in 1981. So very high situation in terms of mortgage rates. Currently, here on the right side of the chart, it's been a rapid increase for sure. One of the more rapid increases we've seen since that period that I was just talking about. But you could point out, well, 6-7% is not very high compared to where we used to be, and that's true. But this has been a very rapid increase, and you've got to look at what home prices have done at the same time, because back in the 80s, the typical home price compared to the typical income for someone was much smaller than it is now. So yes, we don't have 18% interest rates, but if you're comparing, what the overall home price is to, the income people have, it's significantly larger now. So you can't just tell like these millennial buyers who want to buy their first home, well, it used to be worse. That's going to insult them. They know how much they can afford, and right now it's tough. So just bear that in mind. Let's focus on this last 10 to 12 year stretch. And so I'm going to zoom in on the chart. Now we're just looking from 2012 on. And what I first want to point out is that before the pandemic, our previous all-time low for the average mortgage rate in the US was a little bit south of 3.5%. And that occurred in late 2012. We didn't stay down there very long, but that was helpful in kind of reigniting our housing market after we went through a very bleak period, and getting people back in. And that's also right when employment really started to recover after the Great Recession was around then. And Florida recovered faster than most states. But then we don't get back down to that level until 2016 again. We don't quite get there, but we got close. But again, very briefly. And then in 2018, we actually had a recent high, and we almost got near 5% there in late 2018. That slowed down the market a little bit. But what we really got to focus on for the situation we're in currently is this almost 2-year period of record low rates that we just experienced, starting in pretty much right when the pandemic began. Rates were already on their way down at that point, but the Fed pushed them even lower. The Fed had to push interest rates in general lower just to keep the incentive for lending and borrowing money moving, so that the entire economy wouldn't freeze up. Because we all remember what it was like in early 2020 when the pandemic seemingly came from nowhere, and that first month or two, we were all panicking, figuring, trying to figure out if our family members are safe, how bad is it, how deadly is this virus, will we be able to work, things like that, were occupying our mind. Then, as we started to settle into a work from home economy, um, that's when things got interesting, because I think people quickly discovered that uh, they were spending a lot more time with their homes than they previously had, at least those who were usually out of the office. And they're discovering two things. One, I need more office space in my home. And if they have children, I have four. So this was particularly acute situation for me. Gosh, I'd like more space, either outside or inside, just to get them away from me for longer periods of time. So people's idea of their current home and people's idea of what kind of home they need has changed a little bit, and it definitely changed during the pandemic. And that, combined with all-time low interest rates, and prices hadn't been rising that much yet in early 2020, that caused, and we have nothing better to do than browse online and look at listings. The combination of all those things really ignited our housing market. But just as the Fed gave us some candy that made us like hyper school children, they did have to take the candy away, especially as soon as inflation started rearing its ugly head and the economy got too hot. So they have to slow down the economy, because inflation is just, when the prices of most things are going up. And so it wasn't just housing, it was everything, goods. Like, what were all of us doing during that period of time? We were buying everything we could off of Amazon.com until we couldn't get out our doors because there were so many packages piled up. So tons of spending, and that was bidding up prices on top of there being supply chain issues that was forcing a lot of higher prices on the business side of things. So all of those things combined caused the Fed have to raise rates, and they've raised them pretty rapidly. And as a result, the interest rates for the 30-year fixed rate mortgage have gone up. Now, they reached about 7% in November of last year, and since then they've settled down a little lower than that, but still in the 6 to 7% range. And as of, I think, this week, they're kind of back up closer to 7 again. There's going to be a little bit of volatility in the rates until the debt ceiling issue gets resolved. But after that, I expect them to be in pretty much the same place they're at now, maybe a little higher, maybe a little lower. But that's the situation where we're at. So let's look at that. On the top chart here, I've got data for Florida going back to 1993. This is our median sale price for the state. So half the homes each month sold for more than that, half the homes each month sold for less than that. I've also adjusted it for inflation so that the value you're looking at is in terms of what today's dollars can buy you. So in terms of today's dollars, in 1993, we were still below $200,000 in terms of the median sale price for homes. But that is now above $400,000. I want you to key in, though, on the last segment of this graph. You can see that right as the pandemic starts, right here where that red arrow is, prices were instantly being bid up. There were so many people flooding into the housing market from the get-go. As soon as those rates dropped to all-time lows, and as soon as we were able to sell real estate again, which in Florida was pretty quick, we started to see the increase in prices almost instantly. But you got to contrast that with, okay, well, what would the monthly payment be on the mortgage for those homes? Because rates were pretty low in 2020 and 2021. Well, over those 2 years, that monthly P&I payment barely went up, hardly at all. So you're talking about going from like $1,100 to $1,200 to $1,300 a month. A lot of people could still afford that. But now we've gotten into the past year where prices continued to go up over the past year. And at the same time, the mortgage rate was going up fairly rapidly. And so now we're looking at, for the typical Florida home, you're talking about $2,000, and that's just P&I. We're not even factoring in your property taxes are going to be much higher if you're moving in from out of state and you didn't have portability on an existing home in Florida. Well, and insurance has gone up drastically as well. So all of those things are really putting it to affordability in our state. And that's the reason for the slowdown. So I'm going to talk about the Orlando metro area today. So that's the 4-county area I'm showing you here. And so these are the statistics for this market. And this is closed sales over each year going back to 2018. And I've just put them on the chart alongside each other by year so that you can see the seasonality of each year. I'm going to focus first on these pre-pandemic years, 2018 and 2019. Those are our last two, what we would probably consider normal years in real estate here in Central Florida. And they were pretty much right in line with each other both years. 2018, December was a little bit down because if you remember, that's when we were going into the longest government shutdown we've ever had. And there was a little bit of stock market volatility back then and a little bit of worry about things, but that actually resolved by early 2019. But now let's look at 2020. 2020 starts just like 2018 and 2019. In fact, a little bit hotter in January and February. Then we have our 3 months of very subpar closed sales due to the pandemic. And so fewer closings in those 3 months. Our spring buying season was completely dashed. But by July, we're starting to see closings at or above where we were before the pandemic. And then the last 4 months of the year, we have one of our best second halves of the year of all time. That didn't really prepare us for what 2021 would be like, though, it was our first spring buying season in 2 years, and the closed sales there were just tremendous in terms of the number of sales. By this point, remember, we're out of an eviction moratorium situation, so being a landlord isn't as difficult now, and that's when we saw rents start to skyrocket. And so that's bringing in investors on top of the buyers we already had from 2020, late 2020. So investors came in full force in 2021. Then we get to 2022, and by March, the rates start to rise. You can see that early on in 2022, we're actually right along the lines of 2021, but by March, those rates are rising and sales start to slow. And so the second half of 2022, the second 2/3 of 2022, really, we're more in line with 2018, and we're actually quite a bit below that by the end of the year. So we're back to slightly less than pre-pandemic levels in terms of sales. And that brings us to 2023, where we've had a couple months of stability now. So rates haven't really increased since November on, relative to how they were increasing before that. But they're still quite high, and we still have high prices. So as a result, that's why sales are slow this year compared to definitely last year, but even pre-pandemic levels were a little bit below that. If you look there, there's our 2018 level. We're kind of following along with 2018 still, but a little bit below it. Now, if you want to look across the state, here's the number of sales we saw in April in each county of the state. And there in Central Florida, you see Orange County had almost 1,500 sales, and then 744 in Lake, 514 in Seminole, and 783 in Osceola. So that's all well and good, but what we want to know is, okay, but how much did that change compared to last April? And that's what these percentages are. So this is the year-over-year change this April compared to last April. And you can see Lake County actually not down a whole lot compared to last year, only 8%, but the rest of the metro is in the low to mid 20s in terms of the percentage drop. But that's pretty much in line with a lot of the rest of the state as well. You see weaker sales in that range in the Panhandle, you see it in the West Coast, and even bigger sales drops here in South Florida, 31% in Broward and 36% in Miami-Dade County. Now let's compare April 2023 instead to last year. Let's compare it to 2018. So, which we were just looking at how 2018 is kind of where we're falling. There is a little bit of difference there. In Orange and Seminole, we're still down about 22, 26% from that point. But in Lake and Osceola, where there's more development, there's more building, there's more um, uh, some more opportunities. We're actually up from that level in 2018. You also got to remember back in 2018, I think Lake and Osceola, definitely Lake, had very limited inventory. It was one of the, and so that was limiting sales back then to a degree too. Now we can look a little more forward and look at the number of homes that went under contract each month. And in April, and actually all of this year, there's a, it's been a little bit low compared to where we were pre-pandemic and during the pandemic. But I think in large part, most of the homes going pending this year so far, are having a better success rate of closing out. And that's why closed sales are a little bit closer to 2018 than new pending sales are. So you've always got to take that into consideration. As you know, not everything going pending is going to close. So we have some of that. I don't have a chart in here for pending inventory, but we also count how many homes were pending status at the end of the month, each month. And that actually ticked up from March to April. So that's telling me that there's also a little bit of a lengthening in the time it's taking properties to close. So we might see some of that show up in closed sales in the next couple of months. So we might get a little bit back closer to that 2018 trend in the next couple of months. We'll have to wait and see. Now, in terms of forecasting, I've got a pretty small shop at Florida Realtors. There's only 3 of us right now. We usually have 4. I'm about to add someone back because we lost someone. But it doesn't give us a whole lot of opportunities to do a lot of modeling because that is extremely time intensive. And I don't feel like it's a good use of dues dollars for me to have my whole team working on that day to day because you can have the most brilliant economists in the room, in the world, working in a room together on a forecast, and they're still going to be wrong half the time. So what I wanted to do was show you, Lawrence at National Association has a lot more resources, and he's able to put some forecasting together, as are a lot of these other large organizations that are in the housing industry. So I just wanted to show you some of their forecasts as of the end of last year for sales forecasts. NAR said that they expect existing home sales to fall 7% this year. They've fallen a lot more than that through the first quarter, but the reason is, if you look at Lawrence's forecast quarter by quarter, he says most of that year-over-year drop occurs in the front half of the year, and the second half of the year, where we're comparing, 2023 to late 2022 when sales were already down, then that'll be less. So he's not saying that every quarter we're going to be down 7%. He still thinks that we're going to be down a lot this quarter, and he was right this past quarter. I've actually enumerated that a little bit here in Fannie Mae's data. Fannie Mae was thinking existing home sales fall 21% year over year, so significantly more than NAR thought. But they said it would be down 35% in the first quarter, and I don't think we were nearly that bad in Florida. We were in the 20s. And up in the fourth quarter, they thought by the fourth quarter we might be up 1% year over year. Mortgage Bankers Association thought existing home sales would fall somewhere in between what NAR and Fannie Mae did, maybe almost 14%. Redfin thought a drop of 6%, Realtor.com 14%, and the National Association of Home Builders, they do forecast existing home sales, even though they focus on new construction, and they thought about 16%. So for that to happen, we'd have to have a second half of the year where we have single-digit year-over-year declines, and that's still possible, but it really, all of these forecasts are highly dependent on where the interest rate is. And if people start to get hope that interest rates will go down anytime soon. And there hasn't been much news since these forecasts were issued that significantly changed that environment. We do have the Federal Reserve indicating they could pause next time they have a chance to change rates. And by pause, I'm talking about they're going to completely stop raising rates. There's also people who talk about maybe they'll pause next time, and then the time after that they might raise again. It really depends on where the inflation data and the economy data are taking them, because that's what they keep indicating they're looking at. So those are the big things I watch every month. Is how did the job creation numbers look? So how many thousands of jobs, hundreds of thousands of jobs were created each month in the U.S. on net, and also the inflation rate when that data comes out with the consumer price index at the close to the middle of every month. Those are the two things that seem to be moving interest rates the most, although they're not having as big of an effect now as they were. That and the Fed, just the Fed hinting at what they're going to do. It's not something you can easily model with mathematical models. You just kind of have to be a Fed whisperer and figure out, okay, what do we think they're going to do? So it's hard to say. That's been the problem this year so far, is that economic data I'm talking about that the Fed watches has been kind of volatile. Some months they look great, some months they look not so great, and it's been difficult to kind of get a sense of where we're going in terms of economic growth. Which, if economic growth slows down enough, then that's technically what we call a recession. If we have 2 straight quarters where economic growth actually declined, or the GDP declined. So we're just watching all those things. But I just want to give you a sense. I show those slides to give you a sense that, by the way, I know all the economists at all of those organizations very well, and they're all brilliant. But the thing is, they're coming up with completely different numbers. And that's just because of how unpredictable our market can be. So I always urge people not to focus in on one single forecast. But Florida is still in actually a pretty good position compared to most other states. So I want to talk about that right now. Florida is still kind of the hot place to be. In-migration is slowing a little bit, but we've been, in that regard, on fire compared to a lot of the rest of the country. We're an ideal location for untethered remote workers. So if you have no expectation of being in the office anymore, why not come to Florida? Especially if you're cooped up in a small apartment where you're spending a lot more than you would in Florida for a big house. Why not come down to Florida and get near the beach, enjoy our lack of income tax? So many reasons to do that. And we also continue to see investment activity from the more expensive parts of the country. So we're still seeing activity out of the Northeast and the West Coast. And Florida's experiencing solid job growth again. We're already back well above the number of workers we had before the pandemic. The US has overall struggled to get back to that point, but in Florida, we're definitely well above it. Speaking of population growth, the last numbers we got from the census are almost a year old now in terms of what they're measuring, but they're saying between the midpoint of 2021 and 2022, our state's population increased by over 400,000 residents. That's second only to Texas, and equates to about 1,142 net new residents per day. So there's actually more people than that moving to Florida every day, but we do have people who leave too. So, but on net, we're getting 1,100 more people a day. That works out to a 1.91% increase over this time span, and that was higher than any state in the U.S., which you might think, well, we're Florida, we grow pretty rapidly compared to other states. But that's the first time we've led the US in that stat since 1957. So we're probably always up near the top 5 or top 10 in terms of growth, but we've never actually led in growth since 1957. So I thought that was pretty amazing. If you compare our 1.9% increase to the overall US population, that only increased about a little less than half a percentage point. So that's a significant difference. Immigration is starting to, legal and illegal immigration are both starting to rise again over the past year, but it was kind of dead in the water during the pandemic. So when it comes to real estate, population is always the biggest driver. The more people you have, the more people you need to house, and that puts upward pressure on home prices. That increases demand for housing services. But something a little more recent that we look at, so that we can't get accurate census data for up to the minute situations, but we can look at kind of other data that can approximate it. So one thing we've taken to doing is asking the state's Department of Highway Safety and Motor Vehicles to provide us with the number of people who are exchanging licenses, who are coming in from other states. When you move to Florida and you establish your Florida residency, you have 30 days to go to the DMV or the tax collector's office, and you have 30 days to trade in your old state's license and get a Florida license. So if you do that, then they track what state you came from, and they do this by county. So I was actually able to pull the Orlando metro area, and I'm looking at 10 of the largest feeder states for the Orlando metro area here. And I wanted to highlight a few of them. Ohio, which is a very typical Midwestern state in the Rust Belt, there was a little bit of an increase. You can sort of see it post-pandemic, maybe by 50 or so people a quarter, but not terribly significant. And you also saw it in a mid-Atlantic state, Virginia, although you can see a little bit more there where there was an increase. But now look at Texas. Now, that's an interesting one because Texas, we usually view it as a competitor for when we're trying to draw people out of the Northeast or the Midwest or wherever. They're a Sun Belt competitor of ours. And yet, on net, we're gaining, well, this isn't on net, so this is just from Texas. The number of people moving from Texas has increased fairly significantly, and it stayed up there. So I thought that was really interesting. That's a statewide phenomenon. It's not just happening here in Orange County and surrounding counties. And then you've got these mid-Atlantic states like New Jersey and Pennsylvania that not only saw a very large increase, but it's kind of stayed up there. Now you'll notice that over the last 2 quarters, there's been a significant drop from every state, although it's picked up a little bit this past quarter compared to the last quarter of 2022. But in the case of New Jersey and Pennsylvania, and I'm assuming a lot of those people are coming out of the Philly area, you've got still a much higher level than we had pre-pandemic of people coming in. So that's quite interesting. But now you look at one of the most expensive housing markets in the country, California, which has always been somewhat of a feeder for us, partly because we're connected to the Walt Disney Company and you've got corporate jobs moving back and forth fairly often. But you've also just got the fact that California is the largest state by population. So they're always going to be up there in our rankings. But now look at what's happened since the pandemic. It's been a significant increase. About 2 years ago, I live in Horizon West. About 2 years ago, I was talking about California. We might see more buyers from there, but they've always been, not a terribly significant percentage of all of our buyers. And within a week of me saying that, a couple from California bought the house next to me. So it's real, right? So there are people coming from California. And you're all wondering I'm missing something here, right? Okay, I didn't have New York in there. And that's just because it distorts the chart if I throw it in. So you can't see what all the other states are doing. But if you throw in New York, they're not just moving to South Florida from New York. They're moving all over our state, and that includes Central Florida. So from the beginning, I've said, don't expect this huge rush in migration from domestic migration from other states to remain at the levels it was at. But I think going forward, because of work from home and untethered work and several other factors, Florida is a more attractive place to move to now than it was before the pandemic for a lot of people. And it makes a lot of sense now to come here when maybe it didn't before. And so I still think we get a permanently higher level of domestic out-of-state demand for housing here in Florida going forward than we had before the pandemic. It's not going to be what we saw in 2021 or early 2022, but it's still, at this point at least, 30% higher than it was before the pandemic. So now let's look at our median prices. Prices in the Orlando metro, and I've got condos, townhouses, and single family all thrown into the same stat. If you look there, it's clear that our rate at which prices are increasing is slowing down. Frankly, I thought that should have happened last year, but it never did. So as soon as rates started rising, I expected prices to cool off and year-over-year price growth to really slow down significantly. It's taken a year for that to happen. So when we think in terms of home prices, I felt like the market could definitely support where we were at going towards late 2021, but by 2022, with prices still rising as rapidly as they were, I'm not as confident about supporting those prices. It could happen, but you can follow the line. We're converging slowly here with last year's numbers. So at some point, we're probably going to be at or below 2022 levels for home prices. Probably. I could be wrong, but you definitely see a much slower rate of growth now. The year-over-year increase here from 2022 to 2023 in April was very small. But still, if you compare to 3 years ago at the beginning of the pandemic, the Orlando Metro, the median price is up 45% in 3 years. That's just incredible. And that's something I never thought I'd see again. So it's happening. Statewide, pretty similar situation, a 48% increase. So in that regard, Orlando looks a lot like the rest of the state. So one thing you're going to want to watch when you're thinking about home prices and the direction they're going and whether they're slowing, well, you can see that home prices are all about supply and demand. It's all about how many people are out there looking to buy and how many people are out there looking to sell. And the ratio of the two kind of determines, well, if there's a lot of buyers to sellers, you're going to see bidding wars. If there's a lot of sellers relative to buyers, you're going to see homes sit and either have to take price reductions or not get listed at all, or get taken off. So now we're looking at the median days on market for homes. This is between the contract date and the listing date for all the homes that sold each month, so that closed. And as of April, the typical home in Florida was on the market for 30 days before going under contract and then eventually selling. That's significantly higher than 2021 or 2022 when we were below 10 this time a year ago. It's also still quite a bit below 2018 and 2019, although not a ton, but it's still much lower than that. But that's a good explanation as any as to why price growth has slowed down, because homes are sitting for longer because of buyers having a little bit more power than they did before. Now let's compare that to the Orlando Metro, where we are back to 2018 levels in terms of median price or median days on market. But you got to look at that comparatively, because before the pandemic in 2018 and 2019, we had pretty low days on market compared to the rest of the state as it was. You can go back, and I'll go back to the state data here. You can see in 2018, it was close to 40 days on the market in 2018 at this time. And then going back to the Orlando data, it was closer to 23 days on market. So that's where we're at now. That's, again, just portends that we should expect prices to be price growth to be moderating quite a bit. So the big question we always get is another price correction on the way? Because all of us are old enough to still be scarred by what we went through 10 to 15 years ago with the previous housing cycle, and which ended as badly as any housing cycle ever in the United States. Well, prices, I'm an economist, I'm just always going to come back to this. Prices are determined by demand and supply. And falling demand by itself, if demand really craters, that can cause prices to go down, absolutely. But for a really large correction, like when people are thinking about 2008, 2009, 2010, and what prices did during those years, we really need more than just falling demand. We also need to see a large influx of supply, which really changes that ratio from where we were at with lots of buyers, few sellers, to few buyers and lots of sellers. So we need a flood of supply. So that's what I continue to explore and look at, is try to figure out where we could get enough supply on the market where where we would really see a large price reduction. In the last housing cycle, that came from two places. One is that we overbuilt, and the other is that we had a lot of forced selling of existing homes through foreclosure. So where could this supply come from? We can look at the home builders, Now that's an interesting one. Home builders, let me throw up Orlando's permit data. This is how many homes were permitted for construction each quarter and at a seasonally adjusted annual rate. So it's just telling you each quarter, this is the annual rate of the number of homes we would expect to be built at that rate. The green line is single family. The blue line is hard to read because it's multifamily, but it's really squiggly. Let's just focus on the single family number for a minute. You can see that we've definitely made a comeback in terms of how much we're building in Central Florida. And that comeback was on its way by 2016. But it hasn't risen to these 2004, 5, 6 levels. On top of that, we went through about 5 or 6 years after that where we weren't building anything. There was no multifamily and very little single family construction. And so we kind of absorbed all of this excess housing from the 2004 through 2007 period. We absorbed that, but then we weren't really building enough to accommodate how fast Orlando is growing. Although on the multifamily side, I have to say we are doing more of that now, and that's a good thing. But you know, the level of housing in terms that we've been building is good. It's positive. We need that housing, but is there enough of it on the market right now to really put a dent in the overall housing market in terms of flooding us with supply? The only way I could argue, I think locally in some areas, if there is enough building, and remember, it was taking longer to build over these last 2 or 3 years because of supply chain issues and labor shortages. We have a lot of inventory of new homes available. A lot of people canceled their contracts because when they decided to build a home and it wasn't done until a year or year and a half later, mortgage rates more than doubled between those 2 points in time. So we had a lot of cancellations. There could be a fair amount of inventory out there, depending on how long the builders want to carry it. But that would locally impact, just parts of the metros where we've really had a lot of situations like that emerge. Now, builders are also able to kind of cheat and buy down rates and incentivize people, and that's what they're doing right now. But you can clearly see that over the last couple of quarters, we're definitely building fewer single-family homes and multifamily homes than we were the past 2 years. Although it's ticked up a little bit over the last quarter, it's still not where we were in 2021. So I say that's unlikely. I put an asterisk there because the home builders could decide, hey, this is our time to strike. We do have these huge generation of millennials looking for homes right now, and this might be the time to take advantage of that. But they're still being restricted by these high rates, and also getting a business loan right now a lot tougher than it was a couple of years ago when the rates were lower. So what about a mass foreclosure event? This is the one that a lot of people have been fearing. That I've had to. This is one of the ones I'm a lot more confident in not being a problem. So here, this orange line is our foreclosure rate, the percentage of mortgages that were in foreclosure in our state each month going back to 2000. And you look at, the height of the housing crisis during the Great Recession, more than 12% of our state's mortgages were in foreclosure. It's ridiculous. And the blue line is how many of those loans were just delinquent by 90 days or more at that time. And at that point, we had almost a fifth, like more than 18% of our mortgages had not been paid in more than 90 days. So in order to get a flood of foreclosures like we had last time, we'd need to start seeing numbers like this. Since that time, we have seen 2 little blips in our delinquency rate. The first one, I call these shark fins because that's what they look like to me, is the first blip is 2018. That's Hurricane Irma. Hurricane Irma, and this is mostly a South Florida phenomenon where there was a lot of disruption to employment temporarily, and and that disrupted payments. But notice the foreclosure rate actually went down during that period. Why? Well, the banks learned something during the Great Recession, which is that it's probably better for us to work something out with our our borrowers rather than put them in foreclosure. And so they had new systems in place to handle that. And that's what happened. And those systems were used during the pandemic, in addition to, just overall the forbearance programs that also ended up being extremely effective. So we see a slightly larger shark fin, but it's more akin to the Hurricane Irma shark fin than the Great Recession shark fin here. And you can notice, as of December of this year, we do see a little tick up in delinquency, but it's not a significant tick upward. And that's obviously when rates hit their highest point. So there's a little bit more delinquency activity than there had been, but it's not. We're still below 2% by a large margin, and there's been very little impact on the foreclosures. If you want to look at, okay, some people tell me we go into a recession, people lose their jobs, then they can't pay their mortgages, then what? Well, the last time we had a normal recession was in the early 2000s. So ignore the Great Recession, ignore the pandemic, look at our last normal recession, the dot-com bust. Here's what happened then. We did see a very slight rise. It's hard to detect, but we did see a slight rise in foreclosures and delinquencies, but delinquencies still never got above 2%. So it's going to take a lot of job losses to really tank the housing market this time and put a lot of people into foreclosure situations. Credit is just so much stronger among the people who currently have mortgages due to the tightening of credit standards after the Great Recession. And in addition to that, everyone's got fixed rate mortgages now. That's not the case. Before we had adjustable rate mortgages made up a much more significant percentage of loans originated, especially, and we had those subprime loans that were really problematic. But now everyone's locked into fixed rates for the most part. Unfortunately, my data don't go back to that period where ARMs were much more prevalent. But if you look at Florida purchase applications by loan type, this is percentage wise, over the last 10, 12 years, we've been between about 80 and 90% of our mortgage originations are fixed 30-year loans. That has been on decline a little bit ever since rates started going up again. It's still in that mid 80% range. But okay, so we're down to that mid 80% range. What's causing us, what are we seeing originated instead? That would be hybrid ARMs, I think mostly 5/1 ARMs, which are, potentially problematic if rates don't go down in the next 5 years, but 4 or 5 years. But for right now, those rates are kind of locked in too. And that's just the loans being originated. If you look at the overall existing loan count, it's still like 1 or 2% of loans out there are not ARMs. So, or 98% or 97% are not ARMs. So we just don't have enough of those out there to cause a situation where these high interest rates are going to balloon those monthly payments to the point where people have to just walk away or foreclose. So I'm very confident right now that, there's no mass foreclosure event on the horizon. Everyone's locked into these lower rates. That causes problems for us elsewhere, but in terms of a foreclosure crisis, I don't see an issue. Investors and iBuyers. Okay, so let's look at that. I've brought a Realtor.com chart in here. The red line is their kind of rental measure for 2-bedroom units nationwide. And you can see 2020, we're still in an eviction moratorium, but by 2021, that's when rents started to really take off, and they peaked early last year and have gone down a little bit, but they're still pretty high. There's still a lot of demand for housing out there. Buying a house has become a little bit out of reach for a lot of people, although there's still a lot of people buying. It's not as many as there were, but they have to live somewhere. So rents are still high. That to me tells me that investing in residential real estate property is still a pretty good proposition. You are no longer going to get the big gains on the asset value of the property you own, because prices aren't going to rise 45% in the next 3 years. But it's still, not a terrible place to be because, and especially in Florida where our population continues to grow, we continue to need to house people. Uh, there's a lot of need for rental space for a dwell. We're still seeing that. The black line is the year over year change. So you could to zero now. Year over year, we're not rising anymore on rents. That's kind of leveled out, but we're still at a much higher rent level than we were before. We can also look at cash sales. I usually look at, because we track the percentage of sales that are in cash. I always follow that because I want to see, it can kind of be a proxy for investors. Investors aren't the only people who pay in cash, and there are lots of investors who finance. But you typically, when you start to see a lot of investors in the market, you're going to see the percentage of sales that are all cash go up. And right now, we're kind of following along with our pre-pandemic level of cash sales. That is a recent development. If you look at 2022, we had much higher levels of cash sales. So investors, I think, to a degree, started pulling out of the market. And anecdotally, that's what I heard. There's still a lot who are active, but that huge ballooning of investment that happened in 2021 and 2022 seems to be over. I throw in this chart. This comes from Fannie Mae. They use CoreLogic's data also, just for some context, because these large institutional investors get a heck of a lot of attention, but investors overall are a huge part of our market in Florida and a very important market. And you have to consider what investors are doing, not just your typical owner-occupant buyer. And here nationally, you can even see in 2000, it was between 15 and 20% of purchases were investors, people who were buying investment properties. And that rose during the up till the great financial crisis. And then after the great financial crisis, investors were really the first people into the market, right? They're the ones who kind of found that price floor and started to say, okay, prices have gotten low enough that I'm going to start buying homes again. And that's when demand for housing came back. And that fell a little bit as normal buyers, owner-occupant buyers came in. But during the pandemic, we're still in this 20 to 30% range. But now if you look at this broken down by how large they are, how many properties they own or are buying, the blue line is individual investors. So these are people who are just buying one or two properties and renting them out, okay? And they make up the majority of investors and investment purchases. If you look at large corporate investors and iBuyers nationally, they make up less than 3.5% of all buyers, of all purchases. So they're important to follow, don't get me wrong, but what we really want to clue in on is what about these smaller landlords, because they're the ones who are really driving the investment market. So where would an influx of supply come from? If we get one, I think it comes from investors. Investors have bought a lot of properties. They're not in the same situation they were before. Those who use financing this housing cycle are at least locked into low rates. They're not going to have to face adjustable rates. But if something comes along where they really want to get out of housing en masse, then they've got to find a better place to put their money. Right now, the stock market doesn't look so good. Like there's a lot of other places you could put money right now that just don't look very good because we're kind of angling towards a possible recession. Right now, you've got a lot of volatility because of this debt ceiling stuff that we go through every few years that I don't want to blow off, but usually gets resolved because otherwise it's a catastrophe. And yet neither party has any incentive to give in until they have to at the last possible second. So I'm just assuming that that's going to happen, but because it always does. But that's the only place where I can see it now. And it really depends on the market. If you were really high in investor activity, you could see some of those homes. And that's the double-edged sword of investors. They can really push up the demand in your market really rapidly, and they can all leave at the same time. typical owner-occupant buyers don't all leave at the same time, right? There would have to be a mass job exodus or something, and that's just not going to happen in Florida. Our job growth is too strong. What about traditional owner-occupant sales? So let's look at new listings of existing homes for sale in Orlando. In 2021, the story throughout much of the pandemic is we don't have enough inventory, we don't have enough listings. We actually had more listings in 2021 in Orlando than we did in the 3 years prior. We also had a pretty similar number last year. But in 2021, especially in the summer, we saw a lot of listings. The problem was we did have low inventory at that point, but that's just because homes were selling in like 5 seconds. So, at the end of the month, when I would count the number of homes that were actively listed, a lot of the homes listed that month were already gone. So they didn't show up in the inventory number. So you go on a website or something else and look at how many listings there are, you wouldn't see very many at any given point in time, whereas now you'll see a few more. So let's look at 2022. 2022, we also had a really large number of listings in the summer, but rates really started to impact people's decision making, and you started to see actually below normal levels of new listings, and that's actually where we are right now. We're seeing below. Now, there was a headline in the Wall Street Journal the other day that drove me crazy that said nobody is listing. Well, that's not true. Maybe about 20% fewer people are listing, but 80% of them still are. So we've got to deal with that. As a result, active listings are actually still going down. So because of the fewer new listings, we're also seeing that's actually outweighing the fewer sales. So we're actually seeing inventory go down again. And if you look by county, I know I'm out of time here. But by county, compared to a year ago, everybody's got more inventory. In many cases, more than 100% more inventory than they did a year ago. But compared to the pre-pandemic period, we've still got a lot less inventory. On a month supply basis, Florida condo month supply are getting up close to 3.5 months of supply. We're still below 3 months of supply for single family. In Orlando, both property type categories are right around 2 months supply. So still a pretty tight market. That's just indicating to me that prices are going to level out. There's no indication that prices are going to tank anytime soon. I just think this is why this market is different than the last one when we had the housing bubble, because this time, instead of a lot of supply, we still have very little supply and relative to demand. And so even though demand has gone down because of these high mortgage rates, we also have very low supply, in part due to the high mortgage rates. And so I think that keeps us balanced out. Some more forecast data. I provided the slides to Jay. You can get them from ORRA. Same kind of thing, though, a little bit of uncertainty in where we're going to be. But let me close on dollar volume. Dollar volume, okay. Yeah, where we're getting hurt is not home prices falling down. Home prices have been rising and they're leveling out, but they're not falling. Where our industry is getting hurt are closed sales. Closed sales, that's where we're getting hurt, and we're not getting enough listings. So it's the number of transactions that are hurting us. But the high prices are offsetting that, at least in terms of dollar volume for now. So as of 2023, our dollar volume levels, the amount of money that's changing hands each month in real estate transactions, it's below 2021 and 2022 levels, but it's still way above pre-pandemic levels. So yeah, you're getting fewer listings, fewer transactions, but each of those is getting is for a lot more money than it would have been 2 or 3 years ago. So that's the only solace I can take away from the current market right now, is at least dollar volume is staying above where it was pre-pandemic. But I guess I left maybe time for 1 or 2 questions. A lot to cover. Hey, that's okay. I just gave you a lot of info. I did pass along the copy of the slides to Jay, so she, I hope, can distribute those to all of you. And if they're unable to, then you can always email me at research@floridarealtors.org, and I'll be happy to pass them along.
Awesome. Sorry, I'm having some technical difficulties in our boardroom, but I just wanted to thank you, Dr. Brad, for such an awesome presentation. I will be emailing everyone these slides after this meeting. And I just want to say before we end, that ORRA is having our upcoming RPAC auction on Friday, June 9th. Pack your bags and get your passport ready as we take you on an unforgettable journey around the world to indulge in the most delectable food and wine. This will be a high energy auction. It has captivating entertainment and an opportunity to invest in our industry during this event. This will be held at the Audi South Orlando. There will be different mouthwatering signature dishes from exotic locations like the Far East, India, and the Caribbean, amongst others. So if you want any more information on that, be sure to reach out to our government affairs team at 407-253-3580. If you've missed the previous Coffee and Connections, those are available on ORRA's YouTube page. The next Coffee and Connections will be in June. I believe it's June 14th, but I'll include that at the next on the upcoming email that's going out today. It's covering all things service animals. That was something that the previous session really wanted more information about. So we will have Joel Maxon from Florida Realtors making that just the highlight of June, so that way, you know, we all have an understanding of the new laws that are out. So if there are no more questions, thank you so much for your time, and I hope you all have a wonderful rest of your day.